I am Zane, and I want to ask you one question before we start. If two people sitting in the same office, earning the same salary, started trying to build wealth on the same day, and 5 years later, one of them had $120,000 more than the other, what do you think the difference was? Better stock picks? A lucky investment? A side hustle that exploded? The answer is going to genuinely bother you, because the person with $120,000 more did almost nothing visible. No trading dashboard, no crypto portfolio, no side hustle eating their weekends. While the other person worked harder at building wealth than anyone else either of them knew, and ended up with less money than when they started. I spent the last several months running the actual math on 8 different wealth strategies that people swear by. Not the ceiling, not the one person who got rich doing it, but the median. What actually happens to the normal person who tries each one? 5 of them fell apart completely. 3 of them worked. And by the end of this, you will know exactly which ones are which and whether you are currently pouring your time and money into something that is quietly working against you. The ceiling lie nobody warns you about. Before we get into the 8 strategies, you need one idea that reframes everything else. Every wealth method has 2 numbers that matter. The ceiling, the best case outcome, the person who got spectacularly rich doing it, and the median, what actually happens to the typical person who tries. The people selling these strategies show you the ceiling every single time. The person who turned $5,000 into $500,000 day trading. The crypto buyer who got in early and retired at 31. The real estate investor with 40 properties by 40. These people exist. That is the entire trick. The ceiling is real. But for every person standing on the ceiling waving at you, there are dozens you never hear from, because losing quietly does not make content, does not get shared, and does not appear in anyone's highlight reel. Your social media feed is showing you a sample so heavily filtered towards winners that it has become functionally useless as evidence of what actually works. Zane calls this the ceiling lie. And once you see it, every wealth strategy conversation changes permanently. The most valuable thing you own is not money, it is time. Because time is the ingredient that compounding cannot run without. Every year you pour into one of the losing strategies is a year of compounding you can never recover at any price. So getting these 8 sorted is not trivia. It's the difference between starting the clock now and starting it a decade late. Strategy 1. Day trading. Let's start with the one that has the most compelling sales pitch and the most devastating actual results. Day trading, buying and selling positions fast enough that you never really own anything, just renting price movements for hours or days at a time, the pitch is genuinely intoxicating. You, a regular person, beating institutional investors from your spare room. No boss, no commute, complete autonomy. Now here's what the research actually shows. Studies tracking people who day traded consistently over extended periods found that approximately 97% of them lost money. Of the small fraction who persisted and stayed committed, fewer than 1 in 100 earned more than minimum wage for their time invested. A separate decade-long study found that fewer than 1% of day traders were reliably profitable after accounting for transaction costs. And here's the mechanism nobody explains clearly. Every trade carries a spread, a fee, and a tax consequence. The market doesn't even need to move against you to drain your account. It just needs to stay roughly flat while the friction of constant trading slowly bleeds you. Then your own psychology, buying high because momentum feels safe, selling low because losses feel unbearable, does the rest of the damage for free. Day trading is not hard. It's nearly impossible, dressed up as hard, and marketed as accessible. It's the single most reliable way on this entire list to convert both money and time into neither. Strategy 2. Cryptocurrency. Before this section generates strong reactions, the technology may be genuinely interesting. The wealth math is not what most people were sold. Most cryptocurrencies produce nothing. No earnings, no rent, no dividend of any kind. The only mechanism for profit is someone arriving after you and paying more than you paid. Research from the Bank for International Settlements analyzing millions of crypto users found that as prices climbed, large holders consistently sold to smaller retail buyers. When prices corrected, approximately 3 out of 4 retail participants were sitting on losses. The money didn't disappear. It moved from the people watching the videos to the people who didn't need to. Could you get lucky? Absolutely. People win at roulette too. But buying something and hoping the next person pays more is not a wealth strategy. It's speculation. And speculation is a fine place for money you can genuinely afford to lose entirely. It's a terrible foundation for building financial security. Strategy 3. Real estate hacking. Not buying a home to live in, the empire version. Buy, renovate, rent, refinance, repeat. The Instagram guy with 12 properties by 28. Here's what that strategy actually runs on. Leverage. Borrowed money stacked on borrowed money secured against rising valuations.
When valuations rise, leverage amplifies every gain. When valuations fall or financing tightens, leverage amplifies every loss with equal precision. The investors who built impressive paper portfolios through aggressive leverage in favorable markets and then watched those portfolios collapse when conditions shifted are not rare cautionary tales. They are the median outcome for aggressive leveraged real estate strategies when the cycle eventually turns. The short-term rental version has faced additional pressure from regulatory changes across major markets, neighborhood saturation, and the reality that passive income becomes very unpassive when every competitor in your area has a spare room and a listing. There is one honest version of real estate that works: buying a property, occupying it, and renting out a portion of your own biggest expense. That is not a hack, that is just sensible. The Empire version works for operators with significant capital, exceptional timing, and genuine operational expertise. It gets sold to everyone else as a shortcut. It is not. Strategy 4. Side hustles. This one is not a scam, it's just wearing the wrong costume, presenting itself as a wealth strategy when it's actually an income supplement. Run the actual numbers on a typical side hustle. Drive for a rideshare platform on weekends. Generate $800 in a month. Subtract fuel, subtract the additional insurance cost, subtract self-employment taxes, subtract vehicle depreciation, the silent cost that most people completely ignore. Your $800 becomes something closer to $250 in genuine after-cost income. At real hours invested, that is approximately $12 to $15 per hour. But the deeper problem is structural, not mathematical. A side hustle does not compound. You trade 1 hour and receive payment for 1 hour. The hour is gone. Tomorrow you begin at 0. It's a faster hamster wheel, still a wheel. And every Saturday spent on the side hustle is a Saturday not spent developing the expertise that already pays you 40 hours a week, which is the highest leverage investment most people have completely available to them. The exception that proves the rule, a side hustle that becomes a genuine scalable business, or one that systematically builds a skill that increases your primary earning power. That version graduates onto the list of things that actually work. As a permanent plan, trading more hours for proportionally more linear dollars is simply a second job with worse benefits. Strategy 5. Dividend chasing. This one upsets people who have built their entire investment identity around it, so let me be precise. Owning dividend-paying companies is completely fine. Many excellent businesses pay dividends. Dividend chasing as a distinct wealth-building strategy separate from total return investing is where the math breaks down. When a company pays you a dividend, its share price decreases by approximately that same amount. You have not received free money from the market. You have moved money from one pocket to another and generated a taxable event in the process. What actually determines investment outcomes is total return, price appreciation plus dividends together. And when investors specifically chase the highest dividend yields, they frequently end up concentrated in companies paying large dividends precisely because their growth prospects have deteriorated, and the yield is the only thing attracting buyers. Dividend investing is fine. Dividend chasing as its own separate superior strategy is regular investing wearing a disguise that makes it easier to sell courses about. The moment everything shifts. 5 strategies examined. 5 strategies that fail the median test. Drop a comment right now telling me which one of these 5 you have tried or been tempted by. I genuinely read every single one, and I want to know how many people in this community have been there. If you're sitting there thinking nothing works and the whole financial system is designed to keep regular people running in place, stay with that feeling for exactly 1 moment. Because that feeling is precisely when the next guru shows up with the next exciting thing to sell you. The truth is quieter and considerably less photogenic. 3 of these 8 strategies actually work. None of them trend on social media. Nobody has built a successful course empire around them. They are boring in the way that things which reliably function tend to be boring. Let's go through them. Strategy 6. Low-cost index funds. This is what the person who quietly ended up $120,000 ahead was doing. One fund, no charts, no analysis, no decisions beyond the initial setup. An index fund purchases a fractional ownership stake in hundreds or thousands of companies simultaneously. You are not betting on any single business succeeding. You are buying the entire economy and collecting a proportional share of its long-run growth. Here is the statistic that deserves to be printed somewhere permanent. Over 15-year periods, approximately 9 out of 10 professional fund managers, people whose entire careers are dedicated to selecting superior investments, fail to outperform a simple index fund. 9 out of 10. The professionals lose not because they lack intelligence or effort, but because their fees and their constant trading activity slowly drag their returns below what the index produces by simply existing. The historical long-run return of a broad market index is approximately 10% annually before inflation, and roughly 7% after. $500 per month invested consistently at 7% becomes approximately $560,000 over 30 years. Extend that to 40 years and it crosses $1.2 million from contributions of roughly $240,000 total.
The rest is compounding, working continuously without requiring anything from you beyond patience and the discipline not to sell when the news gets frightening. There is one genuine risk in this strategy, and it is not the fund. It is you. The average investor earns substantially less than the market returns because they sell during downturns and buy back in after recoveries, consistently doing the opposite of what produces good outcomes. The fund does not fail. The hand on the sell button does. Strategy 7. Raise your income. This one is so straightforward that the entire financial content industry conspires to distract you from it because nobody can build a recurring revenue model around telling people to become more valuable professionally. Here's why this matters more than almost anything else on this list, especially early. A 10% return on $2,000 in savings is $200. A single salary negotiation that adds $8,000 annually invested consistently over 30 years at 7% produces more than $800,000. One conversation, approximately 20 minutes of discomfort, $800,000 on the other side of it. The trading strategies Zane spent months examining were chasing outcomes that a single raise delivers more reliably, with a higher probability of success and zero ongoing time investment. Getting genuinely excellent at something the market values, developing real expertise, building a reputation, becoming the person an organization cannot easily replace, is the highest probability wealth move available to most people. It just doesn't trend because there is no product to sell alongside the advice. Strategy 8. Your savings rate. The last one that works is the most unglamorous and the most powerful. The gap between what you earn and what you spend. Your savings rate is the only variable on this entire list that controls both sides of the wealth equation simultaneously. It's the capital you direct toward compounding assets, and it's proof of how inexpensively you can sustain your life, which determines how little you'll ever need to be financially free. The math here genuinely reframes everything. Save 15% of your income, and financial independence arrives in roughly 40 years at typical investment returns. Increase that to 50%, and the timeline drops to approximately 17 years. Push it to 65%, and you're looking at around a decade. Same person, same job, same salary. The only variable is the gap. And here's the part that breaks people's intuition completely. This works at any income level. A high earner who expands their lifestyle to match every raise is on a longer timeline to freedom than a modest earner who keeps their expenses stable as their income grows. This is why some people earning impressive salaries feel financially trapped indefinitely, and why some people earning ordinary incomes build genuine financial freedom in their 40s. Your grandmother's advice about spending less than you earn wasn't unsophisticated, it was just early. Back to the beginning. 5 years ago, two people Zane knew started from the same place. Same salary, same starting account balance, same access to the same markets. The first one, call him Marcus, threw himself completely into it. Trading software, market analysis, crypto positions, a side hustle consuming his weekends, dividend stocks selected for yield. He was the most financially active person in their social circle. He talked about money constantly. He had screenshots of his best days and explanations ready for his worst ones. The second person, call her Nina, automated a monthly transfer into an index fund, negotiated 2 salary increases over the 5 years, kept her expenses roughly stable after each one, and essentially never discussed her finances with anyone. She did nothing loud. She did everything right. 5 years later, Nina is $120,000 ahead of Marcus. Marcus is not stupid. He's not lazy. He's a genuinely intelligent person who was pointed at the exciting losers by a system that profits every time someone trades, subscribes, or buys the course. Nobody earns a commission when Nina quietly buys an index fund and goes for a walk. That's precisely how you know it's the right move. Pen 140. The permission you did not know you needed. Here's what Zane wants you to take from this. You have permission to be boring. You have permission to opt out of the strategies with the best thumbnails and the worst median outcomes. The people building real wealth are not smarter than you. They're not working harder than you. They simply stopped chasing the ceiling and started deliberately building the median. Index funds, income growth, savings rate, none of them exciting, all of them real. All of them available to you starting this week without a course, without a platform subscription, and without a trading dashboard. The wealth was never in the exciting part. It was always in the boring engine running in the background while you went and lived your actual life. Now here's your comment trigger for today, and I want a real answer. Which of the 5 losing strategies have you personally tried or seriously considered? Drop it in the comments right now. No judgment, Zane tried 2 of them himself before running the actual math. And if this shifted how you think about where you're putting your time and money, hit the like button and subscribe to Wetrix Invest, because next time we're going even deeper into the psychology of why smart people keep choosing the wrong strategies. And that's a conversation you genuinely don't want to miss.